We're here to talk about SPX monthly credit spreads, and this is a workshop. And I am going to be covering a lot of my 2021 trades and walking you through each one of those. Also going to share with you how to adjust trades, and I'm going to be also sharing how to adjust a pseudo live trade, right? When it gets threatened, and walking you through that process as well in Think or Swim. Okay, so let's get a move on here. So what can you expect? I'm going to show you how you can make consistent returns monthly based on margin capital at risk using high probability trades, and in this case monthlies, without taking large losses, and make those returns month over month. What are you going to learn? Number one, how to select the right option credit spreads. 2, where to enter and exit your trade. 3, how to prevent large losses. Have a general understanding for when not to trade, and how to trade consistently profitable. That's the goal. I'm going to ask you to stick with us until the end. We got a special bonus. I'm sure it'll be worth your while. If you could just turn off all your distractions, you want to really focus in on what we're going to be covering here, because it could change your trading life. Hopefully you'll find this of great value. All right. Reason number 1, you're interested in learning new strategies that'll take your trading performance to the next level so that you can finally leave that 9-to-5 career behind and trade for a living. 2 is you've seen, heard about, read about others making money trading, and you know you can do it too, but you're just not seeing the account grow fast enough based on your goals. And then number 3, you've tried different trading strategies that you thought, okay, this is it, only to discover that it's just not getting you to that place of consistent results. So hopefully we can get this straight today and get you to a place where you're consistent almost all the time. I live in Puerto Rico. That's my wife and myself, my kids, all grown up. And then my parents, my dad died a couple years ago, but that's my mom and my dad. And that was for an MBA event that I went to. So just a regular guy. I want to start by setting the right mindset, because in trading, the emotions are heavy and you can go up and down and all around, and it can really pull you in different directions. So I imagine what it would feel like if most of my trades were winners. I think about that, what I have to do to make them winners, to keep them winners month after month, and it would be confirmed by watching my account grow. And that's really my goal. I don't set goals necessarily for revenue, just because my main goal is risk management and making sure that that's intact. Okay? And then the rest works out in that favor. So this is one mindset. Here's another. Becoming the trader that no longer takes large losses, but consistently trades according to a proven trade plan that is profitable over time, allowing you to grow your account month over month. So now this monthly trade is the best performing trade that I have. It's a 93% win rate, and the win rate is also very, very profitable, all right? Because you can have a 93% win rate and have one bad trade and boom, it goes away. And this can happen with this trade. And so having capital requirements, not trading too big, making sure that if you do take a loss, you can recover that. And I've done that a few times, but that you'll stay solvent. And that's really, really important. Let's start with actual credit spreads. So now that we've got the mindset right, distractions away, let's really focus in and hone in on this thing. What is an SPX credit spread? And I wanted to cover this. You know, there may be people in here that don't even know what credit spreads are, and that's okay. It's important that sooner you learn it, the better that possibly could be trading. So let's talk about what it is. A credit spread has a combination of 2 puts or 2 calls, where the put or call that is sold is more expensive than the put or call that is bought. You're actually receiving a credit. You're receiving a return right when you put on that trade. Now that trade, it's the max gain when you put on that trade. How Think or Swim looks at it is that it's a vertical. The 10 here is 10 contract. SPX 100 means 100 shares of stock. And in this case, it's the index. So it doesn't mean 500 like the S&P 500. It just says that it's 100 shares per contract. These are weekly options. They expire on Monday, Wednesday, and Friday for the most part. There's also end of month and end of quarter weeklies as well. These are the strike prices. So 30.10, 30.05, and in this case, it's a 5 wide, and this could be 10 wide, 15 wide, 20 wide. So right now I'm trading 10 wides, and you're receiving a credit of 45 cents times 100. So that's $45 times the number of contracts that you sell. So in this case, it would be $450. So that's how you compute the amount of credit that you're getting when you open this trade. So in this case, again, you're selling the 30-10 put, right? The trade is considered to be a high probability trade. And why is it a high probability trade? Because, so let's say right now, the market's at 4,300. And when you put on this trade, the position for a put spread, it'll be way, way lower than where the market is, and way, way higher on the call side of where the market is. And so as long as that position stays within that range, then the position will be profitable. So that's why it's a high probability trade. On the other hand, the risk reward in this trade is very, very low. So let's take this position again. The risk reward on this is $5,000 because you're putting on a 5 wide. So it's 5 wide times 10. So it's $5,000. And the most you can gain on this is $450. So you're putting up $5,000 to get $450. But that's not bad if you're doing this in 1 month. As long as it doesn't breach and go through your strikes, then you're fine. The max loss on this is $5,000, actually minus the $450. And the $5,000 is actual margin requirement for you to put on this trade. So you need to have $5,000 in order to be able to put on this particular trade. Let's say it's one contract, 5 wide. The number would be $500. So you would need $500 to put on this trade. And that is really the minimum for SPX credit spreads. That's a minimum amount. And what I recommend is using at least $3,000 to start. And that is kind of low for these credit spreads. So let's talk about option decay, because that's really the main factor for how these trades work. This particular example are call spreads, and I'm going to show you the rate of decay that occurs based on a calendar period. So from 68 days to 33 days, the rate of decay is 34%. So within those days, that option will decay by 34%. By 33 to 5 days, the rate of decay is 57%, and the rate of decay from 5 days to expiration is 100%. So it really, really accelerates as the expiration comes near. And again, that's one of the main reasons that this trade works, because you put it on and you let the decay of the option work its magic. And what happens is, let's say you put it on at $450, it'll eventually drop and drop and drop and drop until you get to like $100, and that's when you take it off. So theta, or the rate of decay, is one of the profitability factors. Another one is implied volatility. Volatility really jacks up the price of the premium. So when you have a volatility of 30, you're going to be able to get the same premium or a higher premium based on the delta. And we'll talk about delta, versus when volatility is lower, that delta may be high on the volatility side at, let's say, 80 cents. And when volatility is low, you may only be able to get like 60 cents for the same delta. So volatility is a big factor. And so what happens is when volatility is high and it moves lower, that works in your favor. So another one is theta, and we talked about that. And that's really the rate of decline in the value of the option. And then the other one is market direction. And so if you put on a put spread and the market goes up, continues to go up, it's basically helping you reduce that credit. And so the market goes up generally about 60% of the time, 70% of the time. That's why I favor mostly put credit spreads. But there are times like recent, that's not working. It's actually going the other way. But the probability is that the market, goes higher over a longer period of time. And that's why I favor the put spreads. So let's talk about risk management. I'm going to walk you through this. Always trade with a plan. Always have a plan that you have, and that plan should include entry, how you manage risk, what your adjustment strategy is, what your delta is, when you take it off, all those things that determine what your plan is going to be. Determine what your max loss and risk reward. Know that and understand that, so that you have a clear understanding of what's going to happen if things go bad. That way, when you do put on the trade, you'll be cognizant to say, okay, this is the capital that I have. I have to trade this size in order for this to work. And just one more thing on trading big or trading small. When you're trading big and trying to make money quickly, what happens is that if the trade goes against you, your decisions are likely not to be part of your trade plan, because what happens is there's fear and greed and all these psychological issues that go against you, and it's really difficult to trade when you're like that. So relatively speaking, it's very important that you trade small enough so that your decisions are not emotionally driven by your trade plan. Really important to understand that. Do not allow more than a 2% loss trade based on trading capital. So basically, if you have a $10,000 account, the 2% loss would be like $200. So you don't want to go over that kind of a loss. And that is a good guideline for you to keep your account solvent. So for highly trending market, position trades to follow the trend. And most of the time that's up. but there are times when it's down. In that case, you would put on call spreads mostly. Never hold a short-term credit spread overnight. And when I talk about short-term, I'm talking about like 1 DTE. And so if I have a trade that's going to be expiring in one day, I'll roll that trade. Even if it's far out of the money and my target price has not been reached, I'll roll that trade for several days. You'll actually get a very good roll, and we'll talk about roll in a few minutes here. But you never want to leave it to chance, because overnight you're not able to control the position and it can go against you and you can wake up with a full max loss. Size your trades to ensure emotions are not part of the decision-making process. I always say trade small and trade often, because trading often too allows you to get experience in trading. And so experience in anything that you do is very, very important, and trading is part of that. And so you want to gain experience in trading consistently, and trading small, you'll benefit from that. By the way, I put together a really slick PDF that explains my 3 most popular SPX trades in detail. Get the trade plan for free by clicking on the link in the description. Review areas of support and resistance. So understand support and resistance areas. We're not going to cover that in this lesson today, but I do have videos about Fibonacci and those kind of things. And that's a whole lesson that you need to understand. I review the dollar because the dollar governs the pricing of products in the S&P 500. And so if the dollar is high, then pricing overseas is more inflated and your earnings can drop. On the other hand, if the dollar is low, then the opposite happens. And I do review the 10-year treasury, and lately that's been very popular, just because when interest rates go higher, bond rates go higher, and I just look at the 10-year. And what happens when the bond rates go higher, interest rates go higher. And so companies with a lot of growth and using a lot of dollars to grow their company can get hurt because of the rate that they have to pay for that money. I look at ES futures because futures trade from 6 p.m. Eastern on Sunday until 5 p.m. Eastern on Friday. And it governs where the S&P 500 is going to open depending on where futures are. So I always look at futures and what the trend is. And sometimes when the market opens, it'll pivot from a direction that the futures may have had. And that happens often. So you can kind of look at that and make decisions on where the trend is going to be. Determine your credit spread positions, what you're going to put on. And I always put them either in a trade journal or in a place where I can see them all the time. So as soon as I put on a trade, I'll put in a closing position on that trade. So I always have a track that I can see on a consistent basis and always have understanding and knowledge of where my trades are. All right. Post-market routine, determine if rules were broken and why. If you're trading according to a plan, you want to know why you're breaking the rule. Is it a guideline or is it a real rule that you follow? And make sure that you're sticking to that. Determine risk. If risk was within acceptable levels, especially for wins. And so if you're breaking rules and getting wins, you're going to be complacent. It happens to me all the time. And I always have to check for that. Got to be disciplined with what you're doing, and you never want to be complacent when you're trading. Determine if losses were within acceptable ranges. If you're scared, you're going to trade small and you're not going to get the returns that you're supposed to get. A lot of times you can make a lot of money and then you're going to be complacent, and then boom, that's when it hits you. You always want to adjust for that and update your trade journal or whatever you're monitoring with your findings so that you have an understanding of how you're trading and checking yourself. So let's talk about the strategy. First of all, the entry should be between 30 to 60 days. Typically, I do 30 to 45 days prior to expiration. That's when I put on the monthly trade. Bear spreads, you want to enter them cautiously because, again, the market's generally going up and the distance from the market for a call spread is much less than the distance of a put spread to the market. The reason for that is institutions buy puts all the time. And so they inflate the prices of the puts, and they're doing that because they're hedging. Typically, call spreads are just the opposite. It's to make money. All right. I use a delta of 10 to 12, typically 12 for a bull spread and 5 to 6 for a bear spread. For a 5 wide, it's 30 to 45, what you're targeting for a premium. And for a 10 wide, you want to target around 70 to 80 cents. Let's talk about taking profit. An acceptable take profit is 50 to 80%. I generally move to the 80% side, put on a credit spread at 70 cents, and I'll close it at around 10 cents. That's mostly what I do. The positions that have been rolled or adjusted, the profit target should be less than the other normal trade. And the reason for that is because when you're rolling a trade, you're not going to roll it to the same delta. It's going to be a higher delta. The reason that it's a higher delta too is because generally when you roll a trade, the market has moved in one direction quite a bit in order to get there. And so the probability is that the market, once it has that big move, the probability is that credit's going to eventually go the other way. That's just how the market works. It'll go down in one period of time, or especially for a market going down, or if the market's going up, typically markets grind higher and higher and a lot slower than going down. For the adjustment, you want to take your profits early to get out of that trade because it's already been rolled. It's just a higher risk. It is for these trades to let the positions expire. I don't usually let them expire. I usually close them beforehand, but I know a lot of people who do let them expire. If you do let them expire, I would make sure that you're at least 10% away from the market when you let that expire. The monthlies, I trade AM positions. And the reason that I trade AM positions and not weeklies is because a lot of times when I put on these positions, they're a lot further away from the market. I have personally experienced putting on weekly trades like a monthly, and the liquidity is not there. And you find out when the market has moved away from that position and you want to close it out, you're not able to close it out because there's not bids in that position. Within this year, that's happened to me because I like testing this out every so often, and trading like the NDX as well. The liquidity is much lower than the SPX. A lot of people are trading these things, and there are times when it's really far away from the money that you can get burned because you can't close a position. When you adjust a roll, you want to adjust it 2.5% to 1.5 to 2.5% away from the threatened position before it gets breached. You do this because once it gets breached, it can get really costly to manage, and you don't want to leave it there. Stop losses, it's really not necessary unless a lot of times there'll be a call spread that the market just keeps going up and keeps going up, and I have to roll it and roll it. I mean, I have one right now. All the market has gone down now, but I had to roll that position like 3 or 4 times into different months to get that thing away from the market. And finally, we got some relief there. I would take a loss on that if it's not too bad, and we can just get rid of it and move on for call spreads. And I've done that. So now I'm going to give you an example. And this is a long time ago, but I am going to show you real time as well, just so you get an understanding of what's going on today in this market. You can see here that I put on 35 cents. These are 5 wide. You can see where the market here is in relation to the put side compared to the call side. And it's about 100 points different between the two. And this is very, very typical. And that's what I was mentioning. You know, if the market goes up, and it can rip higher too, just like it can rip lower, you're going to be in a world of hurt if you don't adjust these very, very quickly. This is what occurred here. So the market went down, and now it's just lopsided. So we have a huge difference between the call side and the put side now, where the put side is threatened, and you can see where the premium went from 35 to 90, like 3 times. And this premium almost went down to 0. So the way that you would adjust this trade is this. First of all, you'd want to close out the trade that's not threatened. And the reason you close it out is because if you're going to roll this into another month, you can't roll both sides unless you have double the margin for it. Because you can put on a call side, a call spread, and a put spread. And what that'll do is you'll be using the same amount of margin for just one side or the other. Once you roll it, you're actually rolling into a different expiration. So it doubles the margin. So you have to be cognizant of that. And that's why I say close the position. And that way you don't have to deal with the margin on the other roll. So when you close it, if you close it for 5 cents, let's say, then I rolled this position from December 24.15, 24.10 to 23.40, 23.35. And basically it's for 0. I rolled it for 90. It cost me 90. And then I picked up a 90-cent credit. And so it cost me nothing to roll the position. And you can see here, it didn't go quite 100 points down, but it went far enough for me to be confident that it was safe. All right. Again, a debit of 0. And this is the specific trade that Thinkorswim will show. And we're going to show that in a few minutes here. Okay. It shows you that you're moving it from 21 December to 18 January, 24.14, 24.10 to 23.40, 23.35, and it costs you 0. And then what you do is you put on now the January call side, but further down, and that way basically you maintain that range. All right. And here I collected a 45-cent credit, and so I actually gained credit by doing this roll. And this happens. So the premium originally was 70 cents, now it's 115, and so we came out ahead here. And here's where we ended up. A little bit better, but still not great, right? And again, these rolls, not on the monthly so much, but on the 70 TE, have a tendency to have to be rolled multiple times to get them out of danger. Now, what I'd like to do is go into market here. Just so you know, the SPX today is at 43.28, and I'm going to simulate a roll here, all right? This is the largest position, so I'm going to call it out so you know what it is, and then when you get the replay, you'll be able to hopefully put it in closer and be able to see it. So I'm simulating that I have a position of 41.30 41.20. And the market right now is at 43.20. And so it would be around 90 points away from the market. The position that I would have is 41.30, 41.20. And I'm looking to move it from 18 February to 18 March. And it's telling me it would be a 10-cent debit. So now let's play around with this a little bit. So I'm going to put it up a little bit higher. I'm going to go to 60 and 50 here. Okay. So now it's telling me that I have 0 and it's fluctuating around. And I can tell here that it would probably be between a 0 and a negative 0.5. So let's move it up a little bit more. I just want you to see the relationship here. I'm going to take it up 10 more. Now we're seeing a pretty solid 0 here. Okay, let's make a bigger difference here. But in any case, the higher you go with where you're going to place the position, the higher the credit. And it's okay to roll into a debit if you're really looking to de-risk the position. So this is how you would roll that trade. Press confirm and send, and basically it would move it to the next month to get it out of the way. So in any case, that's basically how you would roll the position. And then as explained on the call side, if you have calls, basically you would do the same thing. You close those calls and then you put on new calls, and you could possibly even increase the premium that you get from your original trade. I have done this many, many times. All right. So that's the example that I wanted to share and how it's done here. And actually, a lot of times I just do this on my phone. It's just a lot easier on my phone and it works out really, really well. So let's go back now to the actual positions that I put on. So this is my actual trades that I did. I have 4 screens of these and I probably won't kill you going through all of them. But in any case, let's walk through this. Right? So let's start out with January 12th. These are 10 wide positions. I sold a spread and 34.25, 34.15 for 85 cents, and then collected $150 because I closed it at 55. So I closed that position when the market went up. I opened it at 85, closed it at 55. And then I put on a call position because I figured, okay, the market's a little higher. Okay. And this is where you can get in trouble too, because a lot of times the market can go up and up and up and up. And so I put on a 40.75, 40.85 at 55 cents call. And then when the market dropped, I put on another put spread for 70 cents, 34.25, 34.15, same put position basically as I had before. And then I closed that put position for 10 cents when the market went up. And so now I sold to open a 41.70, 41.80 call spread. And then I also put on 35.50, 34.40 put spread. The call spread I was able to close at 10 cents. So that's another $225. And I did close another call spread for 35 cents. So that gave me another 150. Sold a 40.50 call spread at 55 and then closed that call spread for 15 cents. So in those trades there, basically I made $1,025 for those trades. Let's keep going here. So now I start with 1,025 and I put on a call spread for 45 cents and then I rolled the trade that I had before from 35.40 to 37.25 for 40 cents. And so a condor is basically a trade that you roll within the same expiration. So what exactly did I do? I took 35.50, 35.40, rolled it to 37.25, 37.15, and I collected 40 cents. Now I'm going to close the call spread for 10 cents here. And then I put on another put spread for 75 cents. And then I did the same thing with this one. I rolled it up because the market was really moving higher at that time. And so I rolled it up and collected another 30 cents. And then on April 7th, I closed the 37.75 position, 37.65 for 10 cents. And I put on put spread for 60 cents. And I put on a put spread half position just because the market was really moving higher and I was thinking that it was going to go down. Now let's go again here. You may think that because I'm going pretty fast in this, that these positions go in and out, in and out. It's not. I mean, if you look at the dates on these things, it's really, really slow. These are just almost set it and forget it type of thing because it takes days after you put on a trade to do it. I kind of do more than expected on these just because I'm in front of the screen all the time and able to do it. But I traded this when I was working in a really full-time career and I would just let them be put on and I would monitor it every so often and just leave the positions and not try to collect a different additional premium. And it does make you money. All right. So April 22nd, I sold 3 verticals at 45 and bought to close put spread for 30 cents. Now I did another condor position to gain additional premium again from 38.25.15 to 39.25, 39.15. And then I closed the put position for 5 cents. Usually I close them for 10 cents, but I guess I really pushed it for 5 cents. Okay. And finally here in May, I put on a put position for 65 cents and then put on a call position. And you can see here that I'm using half positions just because the market was really rocketing up at that time. And so bought to close, a put position for 30 cents, sold to open, a call position for 60 cents, and then put on a put position for 65 cents. And I think that covers it. So those are all my positions from January to May. And you can see here that it just really, really works. All right. The question is, would you like to follow my trades and learn how to trade SPX monthlies and many other strategies and really get to a point where you're consistent? You had mentioned that you're interested in learning new strategies. Maybe you're not seeing your account grow. You haven't found the right strategy. I can tell you that if you start with this very low-key strategy that really, really provides results, just a great way to get into credit spreads. 7 DTE is really a lot faster. 0 DTE, you really have to have a mindset for 0 DTE. But in any case, the monthlies are just an awesome trade to start with. Now, you can go in and learn, train, instruct, practice. That equals success. But the question is, are you going to keep doing what you're doing and hope that one day something will stick? Or are you going to finally take those steps that it's going to put you in a place that it just works over and over and over again? All right. What's the strategy when your put's going 300 points in the money? Yeah, it's not a good one. And just a comment on that. In 2020, when we had COVID, right, and the market went down like 24%, I think, in a few days, I pushed out my monthlies like 3 months out. And I pushed them out and basically let the market come back to them. And I actually ended up profitable on those trades. 7 DTE, I didn't. On 7 DTE, I did have some max losses in there, but I recovered as well. So you really need discipline, commitment, having an edge, and a no-quit attitude. Those are the things that are really going to take you to be successful. And it's not just in trading, it's really any career that you choose to go after. So we do have a trade alert service. It's really based on learning and earning at the same time. And so we do trade these trades, credit spreads, and we also trade futures in there. And it's just a great environment that we have really for everyone. And sometimes there are losses, and that's part of trading. But overall, we have a great community and things work really, really well. We use Telegram because I have my account actually integrated with Telegram. So all my trades come out of my account and it's integrated, and that's where the trade alerts pop up. Okay. So we have chat rooms and channels. Channels are really one-way communication, and we keep those uncluttered. And the chat groups are really for two-way communication to discuss anything that people want to talk about. These are some success stories that are out there. We have a ton of them. I put 3 up, and you can go through them. These guys are really, really happy with the service. And I do have a guarantee: subscribe for 1 month and lose money by following my trades, and I'll refund your subscription. I've never had to refund that subscription. It's worked out really, really well. Right now, we have an offer. You can get the monthly trade for $39 a month. If you want to go up in subscriptions, you'll get whatever the swing trader gives you, plus all the other trades as you go up the line. The normal price for this is $59.99 and $129. So I'm going to share with you the link if you're interested in joining, and hopefully you'll join us. And a lot of people, what they do is they actually join for a month or 3. They learn what they want to learn, and then they move on. And we've made it that way to do that, because people learn in different ways. And I can tell you also that we have people that have been with us for years, and it's really the community that they value. Whatever works for you, I do want to support you, and I do answer a lot of questions, email, and everything else that people have questions on. All right. One more thing. I do have a course. It's $129. Usually it's $149. And if you want to learn in that way, then I'd encourage you to do that. And you'll have opportunity to buy that course as well. So the question is, if you want to learn a step-by-step process to gain income in a market that goes up and down, and you want to finally break the series of losses and account drains, you want to earn consistent income that sets you apart from other traders, this is it, guys. And you get $20 off for life by joining, and we typically have a wait list, but you'll be able to get the same prices as the waitlisters get, all right? We do have professional traders in the group that share their own trades as well. And we do have a training education channel filled with content. And I'm going to be adding more now that I've created a lot more videos. Automated signals with seconds on the trade entry price, targets, and my guarantee that you'll make money. I'd really encourage you to try it, and it may be something that's good for you. And if it's not, I'm here to help you guys. And it's been a long road for me. And hopefully you can learn and make money at the same time without that huge learning curve that I had to go through. All right. So any questions? Let's see. What's your performance 2021 and year to date 2022? 22 is miserable. It's not doing good at all. But again, I always recover from that. My monthly trades, I had a 48% return. My 7DTE trades, I think it was about a 65% return. On my futures trades, it was crazy, but I had a 261% return. So overall, my portfolio for last year, it was about 95% return on all my trades. So I don't think I'm going to have that kind of year this year, especially how we're starting out. This has been rough January here, but you got to take the good with the bad. Okay. Let's see. I do use calendar spreads, but they're not official. Ike is another trader and he puts all kinds of trades on, including calendar spread. Toss uses the phone app. Yes, you can use it on any platform. Thinkorswim works with any platform. Well, you have 5 to 10 wides, 300 points in the money now, and it's really important to know how to deal with it. Yeah, we're working on getting out of that trade. We pushed it out several times, and that's what we're doing right now. And I've been here before, and hopefully I won't be here again. But if I do, we'll be able to push through that. A money back guarantee for whatever reason? No. If you join us and lose money on the trades that I'm taking, then I will give you a guaranteed money back. Okay. Can you show us trading futures? Yeah, we trade futures all the time. And we have 3 different traders that trade different kinds of futures. Ike is a short-term trader. Ted is a scalper, and I am a swing trader for futures. Trade futures with Tradeovate. It's really, I found the best to trade with. You can open an account for $100. For micro futures traders, I'd recommend a $3,000 account to start with. Do I have debit spread strategies? I don't really. Sometimes I do put them on, but they're not official trades. Premium trades are what I was just talking about. These are Ike's trades that he puts on, and he puts on calendar spreads, other credit spreads for other stocks. And so that's what the premium channel is made up of. All right, guys, that covers it for today. I really appreciate your time, and hopefully this was of value to you. And if you need any help, any assistance, email me and I will respond. Okay? Thanks.